Hello, it's a pleasure to be here at Switzer's annual Strategy Day. My name is Steve Bennett and I'm the Direct CEO at Charter Hall. Before we get into today's proceedings, it is important that you understand the disclaimer, meaning that everything I'm about to say should not be taken as financial advice, and if there are any products you are interested in investing in, we always encourage people to read the offer document in full, particularly the risk section. So what am I going to talk about today? Well, I'm going to give you an introduction to Charter Hall. What does the business look like? How we like to manage our property funds. I'll then step you through what unlisted direct property funds look like, including covering off how we like to manage risks. And I'll finish up with a case study as well as providing you with information on 4 open for investment funds, which we currently have right now. So, in terms of Charter Hall, we manage over $40 billion of funds under management in this country. In fact, we manage more commercial real estate on behalf of other people in this country than anybody else. You'll see a common thematic in what we like to do is we like to invest into long WALE, and we love our jargon, WALE simply meaning weighted average lease expiry investments. So that is, we like the longest lease terms possible. We focus on high occupancy levels to very strong tenant covenants, and we want to make sure we're in resilient properties that will go through different cycles. The business that myself and the team look after is $6.1 billion, the direct investor equity there. But you can see on that chart on the far left that around 2/3 of the money that Charter Hall manages is actually on behalf of wholesale investors. So who are they? They are sovereign wealth funds, offshore pension funds, and Australian superannuation funds. In terms of the split of sector, we're across all the major core real estate sectors of office, industrial and logistics, long leased retail, as well as shopping centre retail and social infrastructure. And those thematics I said around the lease term, occupancy and tenant covenants are regardless of the funds that we manage. The next slide you can see up on the screen is very simple. It's a map of Australia showing where we have people. And as you can see, we have people located where we own assets. And the reason why that's so important, and I've been in real estate for a long time, is that real estate is a relationship game. That's relationships with sales agents, relationships with leasing agents, and most important of all, relationships with tenants, both the tenants you already have as well as prospective tenants. So all we do at Charter Hall is we manage real estate and we do it well, and part of the reason why we've been so successful is that we have close relationships and we have people on the ground talking to tenants on a regular and ongoing basis. It means you get opportunities to understand their requirements more, and you can do extensions around the lease terms and deliver requirements that suit them whilst generating win-win scenarios for our investor customers as well. I'll now just give you an overview of the direct property business, which is $6 billion of the overall $40 billion that Charter Hall manages. We focus on providing institutional quality assets and making them available to self-managed super funds, high net wealth investors, as well as retail equity. We have a portfolio of over 80 properties spread across 10 funds. We focus on long-term leases, so WALE, and the WALE average for our funds is 9.1 years. One of the key reasons why we have over 14,000 investors with us today is because of the regular and growing income streams which we provide. We currently have 4 funds that are open for investment, and depending on the fund, they'll pay distributions, that is income to investors, ranging between 5.5% to 7% per annum. Importantly, because we do know that a number of our investors rely on these income streams to support their lifestyle and required in their retirement, we pay these income returns to investors on either a monthly or quarterly basis depending on the fund. But how have our funds performed over a long period of time? Up there on the screen shows the suite that are currently either open for investment on the right hand side, those 4 funds, or on the left-hand side, the funds, whilst closed for investment, we're still managing those on behalf of the capital that we manage. Very pleasingly, the blue bars represent the per annum, so annual returns that each of these funds has delivered, versus the grey bars, which represent the MSCI Wholesale Index, which in our case is the benchmark which we compare our funds to. In all cases, the minimum exceeding performance is 2.6% per annum, and as you can see, there are many cases where that excess return is well above that level. And I've briefly touched on the tenants, and we do focus on very strong, resilient tenant customers. We like lots of cash flow, big balance sheets, And the reason why we do that is that's the best way to secure the income streams for the investors in the funds. A key advantage, and you would have seen it that slide at the start, is that we're across the major core sectors in Australian real estate, meaning that tenants such as Coles or Bunnings or Telstra, we're talking to them across different asset classes and we have different touch points. What it means is we have a greater ability to learn what they want and deliver outcomes that are beneficial to them, which means we can continue to maximise and improve the returns which our funds deliver to investors. So I've now talked about how Charter Hall likes to focus on long-term leases supported by strong tenant covenants, high occupancy levels and institutional quality. But what exactly is unlisted direct property? Well, the first thing is we deliver that institutional quality. So instead of making just these big office buildings, industrial and logistics, social infrastructure assets available to pension and superannuation funds, we believe it's important to offer all Australians that opportunity to invest. So what we do is we pool funds and we invest in the same quality. We also focus on NTA-based funds. So all the unlisted funds are based on NTA, being net tangible assets, and the way those units are priced is based on independent valuations which are obtained every 6 months. So unlike the listed market where it can fluctuate wildly, there's a lot of stability in how the pricing of our funds move, and that's similar to all direct property funds. We will do valuations more frequently if we believe an asset has moved, and I'll give you an example as we come up where we extended the lease and it led to valuation uplift and we made sure that was reflected in a timely basis. You should also consider how direct property can benefit your overall investment portfolio. Because direct property has a low correlation to other asset classes, meaning it doesn't move up and down at the same time and in the same way as the big other investment assets, it also has lower volatility than equities. So what that means is by bringing in a portion of unlisted direct property into your overall portfolio, a self-managed super fund or a high net worth investor can actually decrease the portfolio risk, whilst at the same time extracting some very strong regular income. But because we're in property, I think it's a great opportunity to just give you a short overview, and I'm going to give you 3 examples in this short video of assets in the funds that are open for investment. The first is an industrial and logistics asset located in Western Sydney, owned by the Direct Industrial Fund as well as our wholesale investment fund. The next asset is a high quality A-grade office property located in the Melbourne CBD, owned by the PFA fund. And finally, a Bunnings asset, one of the recent acquisitions by the LWF Long WALE Fund. So I'll now play those assets to give you an in-depth understanding of the type and quality that we invest into. So that was a great run through on some of the funds and gives you a real feel for the quality of assets that we're focused on at Charter Hall. This next slide that's up on the screen right now gives you a look at the 4 open for investment funds. The LWF, which is a diversified fund which is focusing on long-term leases. You can see here the tenants, the Bunnings, like you just saw, that's actually an asset owned by the fund, as well as Helios, a major healthcare group, and Telstra. And I'll give a bit more of a case study example of Telstra because that is the most recent acquisition that fund has made. Moving through to our Div 4, which focuses on industrial and logistics assets located in Australia. It has a portfolio of approaching $1 billion, and in fact, if we complete on a number of deals which we're currently in due diligence on, that fund will be around $1.2 billion prior to Christmas. It offers very long-term leases, so over 11 years, so that's a feature of industrial and logistics property in this country. Again, we focus on the quality of tenants. Mainfreight, for those that aren't familiar, is a large listed New Zealand entity, around about a $4 billion market capitalisation. And this fund is paying 6.1% per annum distributions paid on a quarterly basis. Moving through to our largest fund, the $2.3 billion direct office fund, 5.5% income return on this one, paying quarterly. It invests in the highest quality office assets. It's been around for a long period of time. Around 30% of the income is paid for by federal and state governments, as well as having major tenants such as Coles and Westpac on the rent roll. Our PFA fund, at 7% income, which is paid on a monthly basis, has a little bit of a different twist in the office space. It focuses primarily on federal and state government tenants. As we currently sit here, they comprise around 52% of the rent roll of that portfolio. And why do I think that's important? Well, it's important because they're fantastically strong tenants. They don't go broke, and having them paying the rent roll means I have more security and stability of the income, which is ultimately passed through to the investors in that fund. Should also be noted, we do have other groups like Amex in that portfolio as well, so very high quality tenant covenants. But I think it would be remiss of me, and I don't like these presentations when people gloss over the risks. You need to understand the risks and, importantly, how we manage them at Charter Hall for an investment in unlisted direct property. One of the key risk mitigants is long-term leases. We're not taking short-term lease acquisitions and trying to stretch them out. We're typically buying long-term leases, and then we work very hard through active asset management to maintain and increase those lease terms. A perfect example is recently we extended the Western Sydney University lease at Parramatta from 11 years back out to 21 years. So that is fantastic income security, and it meant we actually had some asset valuation growth off the back of that asset. We believe in high occupancy. We don't acquire buildings with a lot of vacancy and try and lease them up. Yes, that is a strategy that can be done, but yes, it comes with significantly more risk. We will buy high occupancy buildings and then again, like the lease terms, work hard to maintain that high occupancy level. It does mean at times you may leave some rental growth on the table, but we think you need to look at not just the return profile, but the level of risk. Strong tenant covenants, I've talked about that in depth. The leases that you sign, even if they're on a long term, are only as good as the strength of the tenants who are paying those rents on a monthly basis. We believe in appropriate gearing levels, and we take the longest term debt we can whenever it's available. We think a gearing range of 20 to 40% is appropriate for unlisted direct property in this country. And do be careful of funds that are offering significantly higher income returns. The first thing I would check is the level of gearing, closely followed by the asset quality. We will also pay more to take longer term debt. It's much cheaper to get bank debt on 2 or 3 year terms. However, whenever it's available, we will take 4 and 5 year debt term, even if it costs us a little bit more in terms of interest costs, because that de-risks the fund significantly. And finally, you should understand that direct property is an illiquid investment class. What that means is you should be aware of when the major review events are. For the funds at Charter Hall, they typically are rolling 5-year liquidity events. It doesn't mean you need to stay in for 5 years, because it does depend when the last liquidity event was. So if it was 2 years ago, there's typically 3 years to go before the next one. But it is important to understand that unlike equities, you can't just invest and redeem your money straight away. I don't think that's a negative. It does reduce the volatility, and it does provide that portion of your portfolio that can generate those very strong income returns. But it is something I always make sure people go in with their eyes open. I'm now going to talk through a case study on the most recent acquisition of the Long WALE Fund, LWF. It invested alongside a number of wholesale capital partners into a portfolio of Telstra data exchanges. And so what were some of the things that the team and myself liked about this acquisition? Well, the obvious one is the strength of the tenant, Telstra. The second one is the length of the lease term, 20-year lease term. And finally, with 100% occupancy, it benefits from what's called a triple net lease structure. Triple net leases are simply a fancy way of saying the tenant is responsible for all costs related to that property, whether it's capital improvements, the rent, repairs and maintenance, and building outgoings. What that means is it delivers certainty of income to the fund's investors, and I don't lose any cash or cash flow paying for repairs to the buildings that I wasn't expecting. So this is an example of how we like to partner up with some of the biggest investors in the world and Australia and make these opportunities available to retail investors, self-managed super funds, and high net wealth investors. So now to close for today, I hope you have a greater understanding of the capability and the breadth of Charter Hall's experience. We've been doing this since 1991. We are a real estate specialist in this country. We don't do anything else, so we need to do this very, very well. We've got a long track record of delivering outperformance for our investors, and we do this by focusing on the security of income, high occupancy levels, focus on the tenant strength, and only investing into the highest quality real estate. You can see here up on the screen the four circles which show the open for investment funds, which range from a diversified fund, an industrial and logistics fund, and two office assets which have slightly different mandates. And they offer different income levels as well as different investment theses. I always encourage people, if you are thinking about investing, please do read the offer document in full. And if you have a financial advisor, please do consult them. Thank you very much for listening to today's presentation at the annual Switzer Day. And the contact details are up there on the screen. If you want to know anything more about Charter Hall or the funds I've talked to today, please do drop us a note on the email or feel free to call us. Thank you very much.